So everyone, just want to thank you for coming out the other night for the Real Estate Investor Meetup group. Here's the spreadsheet and the screen share I was trying to show you. And basically I just want to show you very simple things, what the impact of fees are, what happens when the market goes down, and why maybe a cash value whole life insurance that's specially designed might be something for you. So let's kind of dive into this. First of all, I just did the S&P returns for the last 20 years, and you see them all here repeated over and over. First thing I want to show you is the impact of the 1% fee. So I mentioned that when you buy a home, you pay a one-time agent commission, and you're not charged a percentage of the value of your home and any of its growth for the rest of your life. So in the case of a financial advisor, they actually charge you a fee for the value of your account, and that affects the balance. So let's go something just simple as a 1% fee. How does that impact your growth if you invested the maximum 401k starting in year 2000? So right now you can immediately see you're about $100,000 short between having a 1% fee and what the market rate would have been without a fee. Let's look here, and just for comparison, what happens if you don't have any losses in the negative years and you would just get a zero, but instead of gaining the whole growth, let's just say you got about 25% of the S&P. So you're not quite gaining as much with no losses, no fees, but we're going to get to that in a little bit. So I'll show you where that might come into as an advantage. The other thing I want to show you here is what happens when you just get contractually guaranteed 4% from a whole life policy. So again, it's not looking very fancy. You might say, well, why would I choose that over a managed account even with a 1% fee? Well, when you're growing your money, it's not as important as when you start withdrawing money. So there's something that I like to call negative compound interest. Everyone always talks about positive compound interest. But when you start adding in fees and when you start withdrawing money, that actually has a compounding negative effect on the growth of an account. So I'm going to show you that here. Now, two things to pay attention to. Here's your balance of $789. Here's your balance if it was the whole life guaranteed at $583. And let's see how that plays out when you start taking out money. And we'll get to this bonus here in a minute. All right, so withdrawals. Just to make everything even again, let's put in our 1% fee. So let's just imagine we repeated the S&P for another 22 years, and you took no money out. What would be the impact of that 1% fee? You see, this is huge. That's $400,000. So with that 1% fee, you're still gaining ahead of no losses and a partial performance of the S&P compared to the guaranteed growth tax-free from the life insurance. You're outgrowing it, but still, this is no headaches. It's a guaranteed 4%. All right. So, has anyone ever heard the 4% rule? It's something that advisors tell people, financial advisors, because they've run what they call Monte Carlo simulations over and over again to show you what you can safely take out without running out of money. So there's a reason why they don't call it the 5% rule. Let's say here you retired in age 63 and you were in the year 2023. What happens when you start withdrawing amount? And let's say if we did 5%, what would that look like? Well, the reason why it's called the 4% rule is here, even without a fee, you run out of money. Here, with a fee, you run out of money a lot quicker. So we'll do the 1% fee and we'll do a 4% withdraw. All right, so we can see the impact of what a 4% fee or what a 4% withdrawal with 1% fee. And now let's compare them with that negative compounding interest that I was telling you about. So here's your annual withdrawal of 4% of that balance. So your total amount of withdrawals over this time period will be $725. So $725. But you notice with the 1% fee, you have a lot less balance in your account, or gas in the tank, as I like to say. So instead of 273, you only have 67,000. Now that's why they say the 4% rule here. You're not running out of money at age 85. You're probably not going to run out of money, but that way, if you did, you're not running back to your advisor saying help, or what did you do? Why do I not have any money left in the account? Just as a comparison here, I want to show you continuing returns. If you never lost money in those negative years, and yeah, you only got 25% of the S&P, where would you end up? Well, you'd still have the same amount of withdrawals, but not paying a fee and not losing money even with a partial gain, you pulled out the same amount of money, 725, yet you still have $380,000 left. All right, so that's starting to look a little bit better than paying an advisor. We'll get into that, what this account could be. And then again, let's compare the guaranteed tax-free life insurance account at 4%. So you pulled out the same amount of money and you have slightly a little bit less, so $285,000. And that's not as good as if you didn't lose money, didn't pay fees, but it's much better than if you were paying fees and losing money. So let's do another comparison. A lot of people say, let's go back to these numbers here. So if you remembered, at the end here, you had 789 in the managed account, you have 583 in the tax-free growth. So 789, 583. Here's a couple different options that we have for people. One option is we have certain guaranteed annuities. Now, people hear life insurance, they think, I hate life insurance. That's like saying, I don't like cars. Now, when you say annuities, people have the same reaction. They say, I don't like annuities. Well, annuities, like, I don't like trucks. Well, Honda Civic versus a sports car, a Ferrari or something. So they're both cars, but they're very different. So what happens if, let's say, we got you a very high performance annuity and it had increasing income? So a lot of people talk about cost of living adjustment, COLA. So usually they say 3% for our government employees, something like that. So what would a COLA look like where you could get guaranteed increasing income, and how would that compare to a managed account? So here you're actually pulling out $1 million versus 725. Now you're out of money here. So in that case, you would get a lot more money over the lifetime of your retirement, but you would run out, and then that balance will no longer be available. There is another option. So let's say you were age 63 this year, you wanted to retire, and you said, well, I don't need money immediately. My spouse has money, or I have other funds, or I can get by for another 10 years. We actually do have some elite accounts that we offer people a 35% bonus. So what does a 35% bonus look like if you withheld it for 10 years? And let's paint the overall picture. So here you're not pulling out any money, but immediately with a 35% bonus, your 789 goes to $1,065,000 and change. Again, we're not losing money in the down years. On the good years, we're only gaining 25% of the S&P. So over the lifetime, you pulled out less money, but you have $1 million left in your tank versus $67,000. That's pretty amazing. You can actually pull out a percentage of this amount each year, so up to 10%. So it's not like it's locked up. A lot of people think annuities, oh, my money's locked up, I can't get to it. Well, that's not the case. Again, a car is a car, a Ferrari is not a Civic. So let's get that out of the way. The other thing is, with this account, this is guaranteed income for life. So maybe medical technology in the next several years improves. I don't know if you still have an iPhone, the original iPhone that's over 10 years old now, but we've come a long way, and I think medical technology is going to come a long way in the next 10 years. And the potential to live to 85, 95, 105, maybe even beyond. The other thing that we don't want people to have is we don't want them fees. We don't want them to have losses. We want to make sure that you never run out of money. So that's something very important. So if you were guaranteed this for the rest of your life, wouldn't you feel a little bit more relaxed about enjoying the things you want to enjoy and not staring at stock market charts and wondering what the market's doing up and down? All right, now let's do the final comparison to the tax-free guaranteed life insurance. We're looking at the total amount of withdrawals. It's equal to the S&P with the fees, and there's still a balance. So right now, this annuity is looking good, and the insurance is probably beating the managed account, depending on what your needs are. But the other thing is, this is a guaranteed, contractually locked in. We talked about dividends in the meetup and how they get reinvested. So what happens if you reinvest the dividends? Well, that 4% turns into more like 6%, again, on a tax-free basis. So you're pulling out the same amount of money, and your actual balance in your account is now 1.3 million and change. So let's look side by side. More money, not as much money, more balance, less balance. Same amount of money, much less balance. So again, this isn't for everyone, but this is something that you may want to consider. Also with these accounts, during this time, you're able to pull out these balances for the loans that we talked about, for real estate investing, for vacations, for whatever you want, life's expenses of vehicles and college education and whatnot. So if you want to see how this works for you, definitely give me a call. My number is 360-305-3247. You can also text me again, 360-305-3247. All right, thanks again for attending our meetup, and we look forward to seeing you at the next one. Have a great day.